Welcome back. The Nifty doing extremely well right now, closing in 10 points away from the day's high right now. Stocks which are doing well currently, we have the IT index. That should come up for you. We've been talking about that. The IT index is underperforming, as is Reliance. So any recovery from the lows on the IT index would support the frontline index. That's exactly what has happened. Still under the flat line, but mildly off lows. And the other couple of stocks which are doing well, the financials, Bajaj Finance has moved to the high point of trade. Eternal's doing extremely well, and Maruti as well. In fact, the auto index comes up for you. That has moved higher. Hero MotoCorp and a couple of these two-wheelers have been doing well all through the day. And Maruti, along with the others, have started to do well. And that's reflecting in the auto index that comes up for you at the high point, understandably. But let's get in another conversation. We have, the industrials metals expert joining in from CLSA, Indrajit Agarwal, who's a senior research analyst there, joining in from the conference. Thank you, Indrajit, for joining in. When you speak about industrial materials, the first thing that comes to everyone's top of mind is cement. Everyone's talking about the capex plan and, the kind of outlook that the cement industry has from a long-term standpoint. But in the very near term, the monsoons have been fairly, heavy, and that's impacted cement demand. Pricing has also not come about as expected. So from a cement stock standpoint, where do you expect demand to be in the second half of this year? And to that extent, what would be the best players to, invest in from a near-term demand recovery standpoint?
Thank you for having me here. If I look at cement demand, it has kind of tapered down in the last 5 or 6 quarters or so. It was going well till about, let's say, March of 2024, post which, be it general elections, monsoons, or weakening consumer sentiment, took the demand down. But surprisingly, for the September quarter, demand was a tad better than our initial expectation at about mid-single digit or so. And even the commentary of companies on government capex was not that bad. As we head into the second half of the year, November, let's say back half of November, going into, let's say, March and April, we have almost a 6 months runway of relatively drier weather, where construction activity picks up. On a low base, I think that demand would pick up quite well in the second half. We expect second half demand to somewhere between 6 to 8%. And companies which have added capacities, either organically or inorganically, to outstrip the relatively smaller players, and will continue to do so. Coming into pricing, the industry today is way more different than what it was, let's say, 3 years back. We have seen almost 10 to 11% of industry capacity changing hands, and the top 5 players in most regions now command more than 80% market share. In our view, inorganic expansion is more detrimental to our pricing environment than organic, which is more gradual ramp up. And hence, we think that pricing could actually surprise positively as we head into calendar 26 and so on. When you talk about the pricing being not as good as was expected, in fact, on the other way around, generally in a monsoon quarter, we see somewhere between 2 to 4% price correction, versus that we have seen somewhere close to 1% correction this quarter around. So I think that we are heading for better times for the industry. And while we cannot get into specific stocks, we prefer companies which have a very strong capacity addition pipeline and a well laid out cost reduction plan, which will continue to outgrow the industry both on volumes and profitability.
Okay, Indrajit, the key takeaways from what you said, we believe H2 should be better, both in terms of volumes as well as pricing. Inorganic growth, you said, could be detrimental to pricing. Do you believe largely consolidation in the cement sector is over, or do you feel there are a few big-ticket deals that could still be in the offing, especially in terms of inorganic growth, and would that hurt industry dynamics?
One, there are still a couple of assets which are on the block. I'm sure we all know about that, which could come up. But those assets are anyway operating at a relatively decent utilization levels. So we don't see those assets spoiling the market as such. And second, if it is again taken over by the larger players, we don't see a new entrant in the industry. So while there could be some pressure on pricing, but nothing to be too alarmed about. This is not an industry where we have seen even historically price growth as much as the overall inflation in the country. So that would still remain low, but any price improvement would lead to a significantly higher profitability.
Okay, Indrajit, moving on from the cement space to the metals and materials space. Now, last week we actually saw the expiry of the temporary safeguard duty as far as steel imports are concerned, the 12% safeguard duty that was levied. It's not been, gone ahead and reinforced as yet. what is the base case you're working with? And in case it is not, it hasn't been notified again, going forward, do you expect some weakness as far as steel prices and steel stock performance is concerned?
So we have been cautious on the steel sector for a while now. There are two reasons for it. One, China continues to export a lot more steel than it did in its peak. So in its glut of 2015-16, China used to export somewhere close to 100 million tons of cement. We think it will breach that level comfortably this year. When I look at even the domestic demand-supply environment, particularly for flat steel, we are going to see a temporary overcapacities with the capacity expansion and ramp-up outstripping the demand growth. As a result, the domestic market could also remain under pressure. With that backdrop, if I take safeguard duty into account in my numbers today, Indian steel prices are about 3 to 4% discount to import parity. However, if safeguard duty goes out, we are at a premium to import parity. Until another safeguard duty comes up again, we could see some pressure on the steel prices heading into the next couple of months. That said, when I speak with the traders and dealers domestically, there is a sense that current prices will hold up and can see some bit of improvement if there is more government support. But that, I think, is already built into our and consensus numbers.
So what is being built in is the extension as far as the restrictions are concerned. And if it isn't, you feel that there could be further downside for steel stocks especially. Is that right?
That's correct. So if I look at my estimates per se, I'm already assuming 5 to 6% price increase from spot levels heading into FY27. If that does not come through, there could be some correction to the estimates, particularly on profitability for steel companies.
Indrajit, you've spoken about cement, we've spoken about steel. Now let's move on to consumer durables, another sector we believe you track. H1 has been a washout quarter, especially if you're looking at the RAC segment, even if you're looking at the fan segment. Do you feel H1 has seen the worst get over? Do you feel stocks have bottomed out and can perform from here? Or are you still worried, especially in terms of valuations for some of the larger consumer durable names?
So actually, if I look at category by category, right, when I look at the impact of a cut in GST rate, or let's say the benchmark lending rate or income tax cut, all these augur well for the durables and also for the cement sector per se. However, most of the companies that are exposed have a higher exposure to a seasonal product, like let's say an RAC. Now, I don't need a rush to buy RAC today if weather is cooler. GST is not going to go back to 28% levels anytime soon. So the mindset clearly is to wait out for the season and let's say buy again in March, April, May next year. With inventory levels already being higher, we are likely to see reasonably softer demand, at least in the next quarter as well. While the stocks have underperformed, it has been driven by estimate cuts as well. So valuations have not really tapered. I will still remain kind of on the sidelines in most of these in these stocks. I would prefer companies which are more diversified in their exposure, have a relatively higher leverage to late cycle categories, and not hinge on one or two sub-segments or sub-sectors per se.
Well, that makes it very clear. Indrajit, thank you so much for joining us on the sidelines of the conference. We want to get you once more on the channel once times are a little better, especially for the consumer durable space. But moving on, it's now time for a short break. On the other side, Manisha Gupta joins in with Johnny Taves, the precious metal strategist at UBS. Stay tuned.